Hey guys, you want to earn tax-free rental income? Then this video is for you. Let's get started. Alright, so the Augusta rule, also known as the master's exemption, is section 280AG of the Internal Revenue Code. Now this section in the tax code allows homeowners in any income bracket to exclude up to 14 days of rental income in their taxable income. So why is it called the Augusta rule? So the Augusta rule was lobbied by residents of Augusta, Georgia in the early 70s. So each year, the Masters Golf Tournament is held in Augusta National Golf Club, and the residents of the city wanted to rent their home out to attendees of the tournament without becoming full-fledged rental businesses. So their efforts paid off, and Section 280A was added to the tax code, and fortunately today the IRS Augusta rule extends to all homeowners in the U.S., not just to those who live in Augusta, Georgia. So the Augusta rule states that if a dwelling unit is used during the taxable year by the taxpayer as a resident and such dwelling unit is actually rented for less than 15 days during the taxable year, then the income derived from such use for a taxable year shall not be included in gross income. So in layman's terms, this means that short-term rentals of personal residences are non-taxable. Hold on, time out guys. If you're getting value from this video, do me a huge favor, hit that subscribe button down below. It helps others find this video and encourages our great team to continue to create more content for you. So make sure you hit that subscribe button. Do it right now. Pause the video, hit that subscribe button, and let's keep more great tax tips on how to save money for your business. Of course, with all tax laws, there is some fine print that is worth noting. So let's take a look at that. To qualify for the exemption, the taxpayer must be renting out a dwelling unit that they use as a personal residence. This means that renting out a house, an apartment, a condo, a mobile home, or a boat, or similar property may qualify for the exclusion as long as the taxpayer uses the dwelling as a residence. The Augusta rule applies to owners' primary homes, their secondary homes, and vacation properties. Expenses related to the rental of these properties are non-deductible. The 14-day restriction is cumulative and does not need to be consecutive. For example, if you live close to a popular wedding venue, you might want to rent your home to guests in different weddings throughout the summer and fall. As long as you do not exceed the 14-day rental rule in a single tax year, you can still qualify. And finally, the rental price must be reasonable for the location and on that date. For example, if you live in Los Angeles near SoFi Stadium, your home may be rented out only for $150 per night on the average day. However, leading up to the Super Bowl, you may be able to charge, $500, $700, even $1,000 a night for the same rental due to the increased demand. As long as your rent prices are comparable to the market, you should still qualify for the exemption. So how should you report the tax-exempt rental income on your tax return? So when filing your tax return, there's nothing special that you need to do. You simply do not report the rental revenue to the IRS. In case you get questioned, be sure you keep the detailed records of your rentals. You should be able to prove that you owned the home at the time of the rental, your rates were at market rate, and that you used the home for personal use during the tax year. The Augusta rule can benefit just about any taxpayer. Because the Augusta rule is an income exclusion, it is available to all taxpayers regardless of tax filing status or income level. There are a few ways you can take advantage of this opportunity. So first, use a rental website if you're concerned about liability or if you don't know how to advertise your home to renters. Using a rental website like Airbnb, HomeAway, or VRBO might be worthwhile. These websites can track rental prices and rental dates in case the IRS has any questions. Next, you want to check your local regulations. Before you begin renting out your home, you want to research your local regulations, your local municipalities, and make sure there's no restrictions on short-term rentals. And finally, you want to strategically plan your rentals during the high market time. Since you're limited to only 14 days of rental income, you want to make sure you're getting the maximum amount allowed for those days. All right, guys, so now finally for business owners, perhaps the most appealing aspect of the Augusta rule is its ability to shift income from a small business. So when done correctly, you can rent your home to your small business and receive both a tax deduction at the business level and an exclusion from income on your personal level. Now here's an example of how this might work. So you're an owner of a small business. The business rents your home for, let's say, 3 days for a management team to use as a planning retreat. So during the long weekend, the management team strategizes for the upcoming tax year. The business rents your home at a market rent. The business can deduct the price of the rental as legitimate business expense, and because you only rented your home for 3 days for the entire tax year, you do not need to report this income on your personal income tax return. So next time you need an event space or meeting location, consider using your personal residence. You'll get the tax deduction for your business and not have to report the income on your personal tax return. Really a big win-win. Alright guys, hope you found that video helpful. If you did, make sure to hit that subscribe button down below. It really helps us and helps encourage our team to create more awesome content for you. I appreciate it, and we'll see you in the next video. Take care, guys.